In early 1893, the United States was riding the tail end of a massive industrial boom. The railroad industry was expanding across the continent, fueled by cheap debt and optimistic investors. But beneath this surface of rapid growth, the foundation of the American economy was cracking. The story of the Panic of 1893 starts not with a crash, but with a simple metal, gold. At the time, the US operated on the gold standard. This meant the government promised to exchange paper money for gold at a fixed rate. To keep this system stable, the US Treasury was required to maintain a certain level of gold reserves. However, as the 1890s progressed, these reserves began to vanish. International investors, worried about the US economy, started trading their American dollars for gold and shipping it back to Europe. The crisis was worsened by the Sherman Silver Purchase Act of 1890. This law required the US government to buy millions of ounces of silver every month. The government paid for this silver by issuing notes that were redeemable in either gold or silver. Because silver was losing value compared to gold, investors feared the government would run out of gold, leading them to dump their notes even faster. By the spring of 1893, the gold reserve had dropped below the critical threshold of $100 million. This psychological barrier caused widespread anxiety on Wall Street. If the government couldn't back its currency with gold, would the dollar become worthless? The uncertainty sparked a wave of fear among businesses and lenders alike. Then came the first domino. The Philadelphia and Reading Railroad, a massive employer and a pillar of the industrial economy, declared bankruptcy in February 1893. They had overextended themselves, borrowing heavily to fund expansion that never generated the promised profits. Investors suddenly realized that if a giant like the Reading Railroad could fail, everyone else was at risk. Panic moved quickly from the railroads to the banks. Depositors, fearing their local banks would collapse, rushed to withdraw their life savings in cash. This is what economists call a bank run. Because banks only keep a small fraction of deposits as physical cash, they were unable to meet the sudden demand and were forced to close their doors permanently. By the summer of 1893, the situation had spiraled out of control. Over 15,000 businesses and more than 500 banks failed. Factories shuttered across the industrial heartland, leaving hundreds of thousands of men unemployed. For the first time, Americans saw tramp armies, groups of desperate, unemployed workers traveling by rail to Washington, D.C. to demand government action. President Grover Cleveland faced a nightmare. He firmly believed the gold standard was the only way to maintain global trust in the US dollar. He pushed Congress to repeal the Sherman Silver Purchase Act, hoping it would stop the drain of gold. It was a controversial move that split his own party, but he believed it was the only path to salvation. Even after the act was repealed, the economy didn't recover overnight. The Depression lasted for 4 years, grinding down the quality of life for millions. Unemployment peaked at nearly 19% by 1894. This period was marked by strikes, such as the violent Pullman strike, where workers protested against wage cuts and the harsh realities of a shrinking economy. Historians often point to the Panic of 1893 as a clear lesson in the dangers of rigid monetary policies. By tying the entire money supply to a limited physical commodity like gold, the government had limited its ability to respond to market shocks. When the gold vanished, the liquidity, the ability of people to trade and spend vanished with it. The Depression finally began to lift around 1897, helped by a rise in wheat prices and the discovery of new gold deposits in Alaska. But the political impact lasted much longer. It fueled the populist movement, which argued that the financial system was rigged against farmers and laborers, changing the course of American politics for decades to come. The key takeaway from 1893 is that financial stability depends heavily on public confidence. When a system relies on a fixed, scarce asset, the moment confidence wavers, the entire mechanism can seize up. It reminds us that economic health isn't just about output and profit, it's about the trust that the currency in your pocket will hold its value tomorrow.